Investors eagerly await Jerome Powell's testimony tomorrow. Our next guest says don't get too excited just yet. The market usually gets it wrong when it comes to the Fed's next move. Let's bring in Joe Zidle, Chief Investment Strategist at Blackstone. Joe, always great to see you.
Thanks for having me back.
He likes the nickname, you can tell.
I was Jay-Z.
I've been Jay-Z.
You own it. Original Jay-Z.
He loves
it. Jay-Z owes you. You say a 10 to 15% correction from here is realistic.
I think so.
What's going to precipitate that, in your view?
It is that markets are much more dovish on central bank policy than the Fed is, right? The markets went from, 5 months ago pricing in 2 hikes to, as of last week, pricing in 3 cuts. And we know that the market is always bad when it comes to predicting both the magnitude and timing of Fed actions. So why should this time be any different? You've got markets that are up over 20% in the last 6 months on anticipation of an aggressive rate cut path. And yet, I don't think growth is nearly weak enough to justify it, nor is inflation necessarily weak enough to justify that aggressive level of cutting. So you have this mismatch between what the market expects, really aggressive cuts, and I think what the Fed will deliver, which is going to be something less. And I think that's going to create volatility and downside for equities over the course of the next 6 months.
It's clear that there has been a vast disparity in terms of what the market seemed to have been expecting and what the Fed seems to be ready to do. But very recently, the markets have really recalibrated quickly as well, to be fair to the markets. I mean, when we got the jobs data, we saw Fed funds future recalibrate very quickly. Yep. 50 was off the table, 100% for July. I'm not sure where they stand at this very moment in time. But let's say we get that July cut. Yep. Isn't that what the markets want? And after that, it's who knows? It's whatever Jerome Powell sort of job owns. And so that disparity doesn't exist.
I don't think it's going to be necessarily enough, though, because they'll get 25 basis points most likely in July, but then they're going to want more. And you have to think about the combination of earnings and interest rates, right? And we started talking about earnings just a minute ago because we are in earnings season. And what a lot of people are overlooking is the fact that earnings have been incredibly weak. The first quarter, they were awful, basically down 40 basis points on a year-over-year basis. Second quarter earnings don't look much better, so you don't have earnings growth, and you have a market that wanted much more aggressive Fed cuts, but they're not going to quite get it. So in other words, I think we're set up for some downside. Now, what's interesting is the relationship between the market and the Fed is basically turned on its head from what you would normally expect. If you look at every Fed cut cycle going back to the 1950s, what you find is normally the market's flat in the 6 months leading up to the first cut, because the markets are sniffing out weakness or sniffing out problems. So equities are generally flat in the 6 months leading up to the first cut. And then 6 months after the Fed cuts, the market's up 12%. 12 months later, it's up 20%. We're up 20% coming into the first cut. In other words, the market's already done all the work that they expect the Fed to do. Where we go from here?
But, Jay-Z, that's really important. That's part of the discussion we were having. Is it that Tina situation? Is it because rates are now so low and we're contemplating a cut off of such a low base that equities, money had to go into equities? Do you understand what I mean?
Sure.
I think we're speaking the same language, and that sets up for a very dangerous situation, in my opinion. And the point is, I think they're trying to put lipstick on a pig and saying it's an insurance cut, but really it feels like it's the start of a rate cutting cycle, and especially when you consider what's going on with sovereign debt around the world.
Yeah, I mean, I think if it's just an insurance cut, if it's just a one and done, then there's nothing but downside for the markets, because the markets are sniffing out problems that I don't think exist, right? What the market is saying is there's no inflation. And because there's no inflation, you have to cut aggressively. Well, if you look at the components of inflation for a second, look at core CPI, right? And that's CPI minus food and energy. The single largest component of core CPI at 60% is housing. If you look at rental vacancy rates, they're at the lowest levels that we've seen since the 1980s. And call it the stock of single-family homes is at the lowest levels that we've seen since the 90s. So in other words, you have real tight housing markets, and that leads to upward pricing pressure. That's point number one. Then the other 40% of core CPI are things that could be impacted by tariffs. And you saw that you saw those comments coming out of the ISM survey, where companies across many different industries were talking about supply chain problems and higher input costs. So in other words, a market that says, hey, there's no inflation out there, all of a sudden you look at the biggest components of it and you think, well, maybe there could be, which means the Fed's not cutting as well.
Simple yes or no. Isn't a 10 to 15% correction in the markets by definition going to bring in more Fed?
That's a good question. We've seen this sort of like Fed put. If we go back to where we were at the beginning of the year, I don't know. It could very well be. but I don't think we get an insurance cut when we're up 20% year to date. But I think you bring up a good point. If we get like a 15 to 20% correction, if you get a panic in the market, it probably does bring it back on the table. Which, by the way, if you're looking at this over the course of the next 6 months, I would view that as an opportunity, because I think what's clear is that this is not the end of the cycle. So if you do get that downturn and you do get that panic, I would lean into cyclical sectors. I would lean into the tech, the industrials. I would lean into credit and things like that, because we're not looking at the end of an expansion here. We're 121 months and counting, and we could go a lot longer, in my opinion.
Joe, great to see you. Thank you.
Jay-Z. Why
The
Joe?
original.
Why Joe? Why confuse people?
Love Jay-Z.
Joe Zidle.
That's what we do on this show. People have to pay attention.
You-
It's the cheapest thing to do, right, Pete?
You're right. That's so right.
You asked that question because you think that the Fed would step in.
Well,
We sold off.
the Fed that we know will absolutely step in there. I would also say that, yeah, I know the market's up 20% from December, but it was down 20%. So you get a place where it's hard to really know what's the world that we live in. Look at tech. I mean, look at Amazon. Amazon's within 1% of an all-time high. People say that we haven't seen rotation and that the old leaders aren't back into play. I mean, they're back in play. And Amazon, we haven't talked about on this show, I feel like, in a long time. And in fact, that's right there.
The argument for a cut the president and a lot of people make is, yeah, I mean, we have strong jobs, everything. However, no inflation.
Yeah.
There is, you heard Jay-Z just now. Inflation is in all the wrong places. Nobody wants to acknowledge it, least of which is the Fed. And be careful what you wish for, Melissa Lee, because
Did
inflation.
I wish for anything?
No, I'm just saying in general.
One should,
Inflation
okay.
is one of those things like
what you're wishing
once
for.
that genie's out of the bottle, and I'm not talking about Barbara Eden genie, the inflation
Which is a
genie,
shame.
But that's
Which is a
party's
shame
over.
you're
That's ridiculous. People have been saying that since 2009,
Just saying.
since they went to zero interest rates, and it's never happened. I mean, I think that there's so many different factors at force here in play that relative to last cycles where we've seen inflation become a problem. Just look at technology. Back
A lot
to your
of secular
point.
changes that will keep inflation low.
Deflation's an
All right.
issue. If anything, the byproduct of a credit crisis is deflation. Look at Japan. That's what we're fighting.